start my talk straight on. So this is an good at mathematics, then it doesn't guarantee you success. In fact, we all know that Sir Isaac Newton and all other famous scientists, they were disastrous when they tried their hand in investment. And there are lots of gray zones. Like there is no one clear-cut criterion or guideline which, if you follow meticulously, will guarantee you success. Like we all are from the field of medicine. So for example, in medicine, for example, for serum proteins, if it is less, valuation metrics will not tell you that the stock is good or stock is worthless. So after all, it is a subjective, there is an lot of element of subjectivity when it comes to investment in stocks. Some people may feel that a PE, price earning multiple of 15 or 20 is reasonable, beyond which I will not buy a stock. And the others may feel that if it is a high growth stock, like recently, one of the greatest proponent of value investing, Warren Buffett, invested in Amazon at a PE of 48. So that was quite phenomenal. Such a proponent of value investor investing in a high growth stock available at a very high valuation. So that is an element of subjectivity. Then all of those who are active in our WhatsApp group must be aware that there are various approaches to investment in stocks. Not a single approach is perfect. There are some who follow technical analysis, some who follow fundamental analysis. There is no clear-cut approach which is superior to the other one. But what I am going to talk about is something that I have followed, and after making so many mistakes, have been able to achieve reasonably good results. So this has been my approach. Basically, I never keep cash in my bank account. As soon as there is a sizable sum, usually at the end of every month, it is deployed irrespective of the market levels, PE of the market, what are the macro factors. That is what and I have never looked at the charts. This is a subjective opinion. It doesn't mean the charts are bad. This is just what I have done, right? Any amount of cash, for example dividends, because of this era of dematerialization, the dividends are credited directly into bank accounts, and you get an alert on your SMS, you get an email. As soon as I get dividends from my from stock holdings, that is also immediately deployed. Essentially, I don't wait for the markets to correct, or I don't worry if the markets are good, or Narendra Modi is going to win the elections or not. That has been the approach. And then off late, I had an interaction with a noted, I will not name the person, during the last Consultant Association investor meet, where he claimed that 90% of promoters in India, they are frauds. They are cooking your balance sheets. So it says they say that the best stock to invest may be already there in your portfolio. So it is not necessary that if you have some stocks, 5 stocks or 7 stocks or 8 stocks or how many n number of stocks, it is not necessary that if you have some money in your disposable money, investable money with you, you go and try and find a new stock. You just first try to find out if of all the stocks that you have been holding, which have passed, we will see various parameters, the various parameters, and which are still available at a reasonable valuation, then it's better that you go and invest in that stock. And this is very important, minimum 10% allocation, because if you want to beat the market, then for example Bajaj Finance or HDFC Bank or Pidilite or whatever, the high growth stocks, TCS, Infosys, whatever, if you feel that the company is likely to continue, remember that stock markets They reward the future performance of the companies. What has been already achieved by the company or has already been declared, it is already discounted. So basically, if you feel that the company is likely to continue superior performance going forward, then you should have a large allocation, minimum 10%. And whenever you come across a new idea, you feel that it is, yeah, it is good, it is investment worthy, don't straight away allocate a large amount of money. You start with double, nibble in the stock, 0.5%, 1%, then you observe the stock, you follow the financial performance, quarterly performance, half yearly performance, yearly performance. You follow the management when they come on the TV. You can even listen or see the transcript of the conference call. Each and every company, the good companies, after they declare their annual results, they hold conference calls, which even you can participate, even if you may not want to ask questions, or you may not be competent enough, or you may not confused and may not decide what type of question I can ask. But you just dial in from your mobile phone, you will be directed to the con call, where a lot of celebrated investors ask questions to the management, and the management gives answers. These con calls last usually 45 minutes to 1 hour. So if you listen to those con calls, then also you will get a lot of information, which is otherwise very difficult to obtain in public domain. Once the con call is over, after 4, 5, 7 days, these you can find the transcript of the whole conversation on the company website. So if you go through the company website, then you can understand, realize, because very difficult questions are asked to the management and they have to answer it. And the way they answer, you can judge whether they are lying, or they are genuine. So that is one thing. This is also very important. I basically invest in visible businesses. Visible businesses means, like for example, say in IT or pharma. For example, TCS, Infosys, whatever, they are blue chips, bluest of the blue chips in IT sector. They were growing at more than 100% in year 95 to 2000. More than 100% growth. Now the growth has petered down to less than 10%. But on ground, when you are practicing in your hospital, or when you are busy, whatever you are doing, there is no way that you can know whether the company is growing at 100%. You will know about the performance of the company only when the company delivers the result. Unless the company delivers the result, you are hoping that the company will continue to grow, and then you get the nasty surprise. Whereas some business, pharma also falls in the same category. There is no way to know whether Lupin or Oro or any other stock, some pharma, whether the US business is going along nicely without any hiccups, or they have started facing troubles. The US business, they have exports in the European Union. They export medicines in the Asia Pacific. So there is no way for you to know whether the business is growing or it has stagnated. Whereas there are some very obvious visible business. For example, auto sector, where if you see Maruti, now even in Maruti we know that it has got 50% market share. 2 years ago, they launched few models like Baleno and Brezza, etc. And you could not get, if you wanted to buy the car, there was a waiting list of 6 months. Now when you see, there is zero waiting list. In fact, they have started offering discounts. So before, these will reflect in Maruti's results only when they declare their quarterly results. But being a shrewd observer you will come to know that the company's sales are stagnating. Same is for Tata Motors. When you compare Maruti with Tata Motors, 90% or 80% of the revenue is from overseas business. Jaguar, Land Rover, they're all the Indian models. They are not at par qualitatively with other cars, and they have paltry sales. When you see their sales in India, domestic market, how they are going to do in the international market, that you don't know. Only when the company announces monthly numbers, then you will come to know that the Jaguar or the Land Rover business has started faltering. Another important thing as far as the business is concerned is the domestic business and export oriented businesses. Now increasingly all the economies are getting contracted. There is exports, all the economies, major countries, they have become protective of their own economies, and they feel rightly or wrongly, that is beyond this topic, that if we allow competition from outside, if we allow people from outside and invite people from talented people from outside for jobs in our country, then our country will suffer. So they have started imposing restrictions on imports and import of talent also. So these are the factors. India is the biggest market in the world. From all over the world, companies are coming to India to invest in Indian markets. You look at Amazon, you look at Walmart, all the companies, they are pumping money in India because there is no growth market. All the markets in the West, they are saturated. India is the only place where they get these growth opportunities. So it is basically, I have never invested in IT. I had invested in pharma in 2013, and then we'll talk about it later. And another is financial and consumption. These are all domestic facing businesses. You daily read in the newspapers that PSU banks, they are having resource limitations. They don't have the funds to invest, to lend. Then these NBFCs, Divan Housing Finance, these companies, they are struggling for capital. So that is a huge advantage for those companies who have capital at their disposal, like say Bajaj Finance or HDFC Bank or Axis Bank or HDFC. Because if Divan Housing Finance stutters, then the obvious beneficiary is HDFC, Group Finance, those companies which are well managed. So they will keep growing even at a faster rate going forward. So this has been the few people asked, and I have posted it so that you feel that this is not theoretical talk. It is actually fruitful if you start investing the way I have done so far. It's been 35% CAGR since 2013 up to 2017. 2018 was a flat year. 2019 it's up again. This even after the 2008 crisis, where I lost 65% of my net worth in a period of 6 to 7 months. I have never tried to time the market. I have never exited the markets. Not a single rupee. And then in the 2013 crisis, when the inflation reached double digits, interest rates were close to 10%. We had current account deficits close to 7 to 8%. At that time also, there was a 50% erosion, and then again in 2000 demonetization, there was a 40% erosion in a period of 15 to 20 days. Net worth, portfolio erosion. But still, you have to realize that these are temporary events and the long-term trajectory remains certain. This is a very important slide. And see, the hypothesis is that, for example, when we start our practice, in 1 year, for example, after providing for all the expenses and paying all the taxes, you are saving say 125 rupees per year, right? Of which you use 25 rupees, that is 20%, to run your household expenditure. And 100 rupees which you are saving, you are investing in the stock market, right? Now this is how, if you are able to compound your money at say 20%, which is, I believe, is not difficult. The naysayers may say you anything, but with little prudence, you can achieve this 20% results. This is what will happen. So, for example, so in the first year, at the end of first year, your 100 rupees becomes 120. Similarly, at the beginning of the second year, you add 100 to 120, that is already there. The figure comes to 220. You get 20% on that, there is 44 rupees. At the end of the year, you have put 264 rupees. Likewise, if you keep going down. At the end of fourth year, you have surpassed your 100 rupees. That is your annual savings. In 4 years, you start earning more than what you have been earning. Of course, we have assumed here that your practice is stagnant. That is not what actually happens. Your practice grows initially at a much faster clip, right? Because the base is very small. You are initially seeing, say, 5 patients in a day. Very soon you will start seeing 50 patients in a day. But at the same as you start earning more, you are deploying more funds over here also. So hypothetically, let us assume that you keep your allocation every year. Your practice is static. You are adding 100 rupees every year. At the end of during the fourth year, this 107, it is much more than it equals the 125 almost. At the end of 10th year, it is 5 times. And at the end of 15 year, now you see the magic of compounding. It took 4 years for 100 to become 100, another 100. Then it become, after in the next 6 years, it is 4 times. And in the next 5 years, it is another 3 times. And at the end of 20 years, when I am sure most of us will have experienced that your practice becomes more or less stagnant. It has reached a plateau. At that time, you are earning 38 times of what you have been gaining from your practice. So this is just not a numerical table, it is really possible to achieve this.
Kartik, you are putting 100 rupees every year.
Yeah. So
ultimately at the end of the 20 years, you have put 20,000.
Yes.
Yeah.
And that grows to how much?
2,000.
Oh, it's 2,000.
Fixed
That goes
base
to
and personal product.
This is 22,422.
So almost 10
So
times.
basically, this is what is important. That what this gives you is the freedom to live your life at your terms, practice at your terms. You are not bothered, or you won't worry if you don't want to attend, say, an obstetrician's call at midnight. If you are busy playing tennis or whatever is your hobby, you will do what you want to do. You will live your life at your terms and not someone else's. So it is very easy. You need to do some diligence. Now, this is the basis of achieving this 20% plus CAGR returns. I know in our group many people refuse to believe that you can beat the index or Nifty, and you can even beat the mutual funds also, but that is not true. As I will show you in subsequent slides, you are at a far more advantageous position as compared to a PAS manager or a mutual fund manager. So there is a very powerful hypothesis in the financial markets that stock markets or financial markets are efficient, meaning that everything is priced to perfection. If a company is growing at 20%, if a company is worth, forget about the growth rate, if a company is worth, say, 1 lakh crore, in whatever way you come at that figure, then the market has already discovered it, and they have given it a valuation of market cap of 1 lakh crore. And so there is no way that you can benefit by investing in it. So that is not true. And these are the points by which I am trying to emphasize that these markets are not efficient but irrational markets. For example, this is the most famous quote of Sir Ben Graham. The markets are voting machine in the short term. Meaning, as Pratnesh Bhai rightly says, that movement of a stock price depends only and only on one factor, demand of that stock and supply of that stock. If higher the demand for any commodity, forget about stocks, higher the demand and lower the supply, the price will be higher. So in the short run, markets are voting machine. In the medium to long term, they are weighing machine. Meaning that in the medium to long term, only the fundamentals will reflect the true value of the stock or the company. So this is an example why the markets are not efficient. If the markets are efficient, then no stock would fall 50% in a day, or no stock would rise 10%, 15%, 20%, 25% in a day. We every day, those who switch on to the CNBC, as soon as the market start, they will show you these are the major gainers, 10%, 12%, 14%. These are the major losers. If the markets were efficient, why would they be behaving in this fashion, the prices? And this is another example. In the 1990 to 2000 TNT table, I don't know how many of you were aware or were invested in the market at that time. It was technology, media and telecom. So anything that had technology, media or telecom, they would shoot through the roof. In fact, the newspapers would scream with the headlines, Wipro has crossed 8,000 to nearing 10,000. These were the headlines on the front page. So that is a definite bubble. The stocks were traded at more than 100 P. People keep on arguing that this stock is at 15 P, 20 P, 35 P, 40 P. It is very expensive. We should not buy. Let the markets decide what P the stock deserves. Who are we? Because we are not a major player. After all, it is a cumulative effort of all the market participants that will determine the P ratio of a stock. So this is one. Then this is the TV18 listing. This is from where I was literally sucked into the stock market, because till then, busy with practice, never had thought about investing in stock markets. When the CNBC channel started, TV18 was the IPO, and my wife was working with a famous brokerage, and she said that this is worth investing. So we made two applications. The stocks were offered at a 180 rupees price of 180 rupees. We got allotment on both the applications. It was subscribed 100 times. On the day of listing, the stock got listed at 1600 rupees. That is 10 times of the IPO price, 1600 rupees. And every day the stock would keep on rising. Kutke na buske vade okay nate. So she told me that let's sell it and go to a Europe trip. I said okay. Then I called the broker. Bhai vechi karto. Like no sir, you are committing a mistake. Don't sell. And if still you have decided that you want to sell, then switch to Z Telefilms. This is quite funny and humorous. So okay, I said that I don't want to put even 1 rupee. Amari jetla Z aave jetla lai le. Then the market started, and then I felt that this is quite fantastic. Why are you working so hard in our hospital? So whatever funds that I had invested in the stock markets over a period of 4 or 5 days, they had never bothered what the company was doing, what was the business, what were the valuations, who were the promoters, debt, anything. Broker said buy this, okay, buy this. So he constructed a portfolio for us, 100% exposure in TNT stocks. One of them was Aftek Infosys. It had Infosys in its name. So it was bought at 1700, jumped to 4500 in 15 days. 1700 jumping to 4500 in 15 days. I called the broker and said, you sell it off. Why sir? 10,000 thase. My wife returned from work in the evening and said, વેચ્યા કે નહીં? મેં કીધું ના. લાવ મને ફોન આ બીજે દિવસ ફોન લઈને કે તમે વેચો નહીં, એમ કે 4500 માં sold off. All the stocks I was fully invested. After a while, all the storm was over, and after 2 years, 30 lakhs of my capital was worth 5 lakhs. The same Z Telefilms which I had bought at 2500 sold off at 135 rupees. So less than 180 rupees. That is after 3 years. And all the stocks, this Aftek Infosys, which was sold at 4600, sold at 80 rupees or something like that. From 4600, 80 rupees. So that is the irrationality of the markets. Markets are never efficient. If someone tells me the markets are efficient, don't believe it. Okay? So that was how I got sucked into the stock markets. Then fortunately I am thankful to Bhagirath Bhai. Both our daughters were classmates in Lourdes Convent. So that is how we came into touch. We became friends. And then he said that like ready for talk out of Ramesh Damani. So he said that every Tuesday at 4 o'clock there is a talk on chat by Mr. Ramesh Damani. So you can log in and ask whatever question you want to ask. So that is how I started my second innings. For 2 years, total withdrawal from markets. Never open the business page in the newspaper. Never watch even BC. Don't discuss stocks with anybody. So that was the situation. Then Mr. Ramesh Damani, some of the 100 takers, I would say. It was solely because of him. There was no contribution from my side as far as stock selection was concerned. His arguments were so fantastic, and he kept on. Many readers would ask him what are the books that you should read, and he would give, every time he would give 4 or 5 names. So that is how I started reading books and business dailies. So that was how the next big inning started. That was in 2003 when the markets were at, index was I think around 3000. So now coming to the different approaches of investment in stock markets, as I said, there is a technical analysis versus fundamental analysis. As technical analysis, most of us we know, so I will just rush through it. It is decision is based on price movement. Pragnesh will deal with it beautifully in his talk. So basically, it is demand versus supply. What my argument is this only, that the factors affecting demand and supply keep on changing, and they keep changing very rapidly. Like for example, if the crude, we all have observed how jerkily the crude prices have been behaving. 5% up, 5% down, that was never the case, and that is all because of the geopolitical tensions. So we cannot predict the crude oil prices. If crude oil prices from 60 say go to 100 or 80 or 90 in 15 days, then all your financial stocks which were in heavy demand will witness heavy supply and the prices will come down. Same, and when this happens, usually market players or market participants, they never take out the cash from markets. So they will sell financial stocks and go for defenses like IT and pharma. So demand for IT and pharma will go up. So those prices, stock prices will go up. So that is something which is very hard to predict. And then inflation and IIP growth numbers, movement of the currency within no time. Our currency from 64 to the dollar jumped to 75 from June or July last year to August, September. In 3 months, currency depreciated by almost 15 to 18%. So that is something which is very, very difficult to predict or forecast. And based on the movement of the currency, if the currency weakens, then IT and pharma will see enhanced or increased demand. So that is something very difficult to predict. So there is a need to change the view daily, because this demand and supply keep on changing daily. So it is dangerous for people like us. Only Pragnesh bhai can manage it. It's very, very difficult. So if you want to do investing based on technical, I think you should listen very carefully to what he is going to tell you. So for people like us, it can be very stressful. You can lose your sleep. When you are doing any activity, your focus is constantly, and you are constantly worried about the crude prices and currency movements and etc. So you lose peace of mind. And then these are the characteristics of technical analysis based investment. They are not concerned with valuation, debt, cash flows or growth, or what is the type of industry, whether the company has pricing power or not. That is none of their concern. If the stock is rising, then obviously it is in great demand and you buy. So these are the recent examples where we have seen severe gyrations or roller coasters, like election results. Everybody predicted that it is going to be hung parliament, and if it is hung parliament, then markets will crash 10%. If Modi comes with absolute majority, market could surge by 10, 15, 20%. Modi got absolute majority, but the market did not rise. In fact, the market rose for 500. I have forgotten. I think 1100 points on that day. And after the noon, the market tanked by 500 points. So there was a swing of 1600 points in spite of favorable election outcome for the markets. So that is something which is very, very difficult to predict. In the short term, the movement of the stocks is very difficult to predict. Then this is RBI monetary meet. The expectation was that the rates will be lowered by 50 basis points, lowered by only 25 basis points. And after the meet, this happened. Then when it comes to fundamental based analysis, there are basically two approaches. One is top down and the other is bottom up. Top down meaning that you focus on high growth industries, basically information technology or pharmaceuticals or financials or FMCG, things like that. And then in those industries you try to find out companies having highest growth, right? And these are some examples. Okay, PSU banks you avoid because everybody knows that they are not growing. So if you go by top-down approach, then you may not invest in PSU bank stocks. The only drawback with this is that you miss out on growth stocks in low growth industries, which are the greatest wealth creator. For example, textiles or some other commodity, where the industry itself doesn't grow at a very brisk pace clip. But there will be a few companies, because of their niche management, they will grow at a very healthy clip. And these are the companies where you get maximum benefits. And then another drawback is that there are some stocks where they do not fall into any clear industry or classification. For example, Reliance, they are into retail also, petrochemicals, telecom, so many diverse businesses. So it is impossible to classify it in a particular industry. So you will end up investing, you won't be able to invest in Reliance if you have this approach. And the other is the bottom-up approach, where even here also there are two methods. One is value investing and one is growth investing. You will see it in detail. I have always invested in stocks which have shown reasonably modest growth. So this is the basic difference between growth and value investing. So in value investing, the stocks are available at a discount to fair value. Like if a company's intrinsic worth is say 100 rupees and the company is available at 50 rupees, then the investor will buy at the stock because there is a buffer of 50%. That is your margin of safety. So that, and the hope is that eventually the markets will recognize this disparity and the prices will correct towards the intrinsic value and you will gain from it. Most of the companies in this is what I have observed, that most of the companies which are available at a discount to their intrinsic value, they don't have any growth. And market of late rewards only growth, nothing else. Right? There is a risk of capital loss even if the business is available at 50% discount because there is no growth, and so you will lose. It is akin to like holding a piece of land, this value investing. I had invested in a company called Hindustan Organic Chemicals Limited. Again, a recommendation of Ramesh Damani, 2003. The hypothesis was that on the Mumbai-Pune highway, they have some 5,000 acres of land. The value of that land is in billions of rupees. And the market cap of the stock was hardly 100 or 200 crore rupees. So you could get 100 bagger out of this. So I bought it 60, 70 rupees. It never breached even the 100 mark after 4 years also. So it's very patient game, and you are rarely rewarded with this. Another example of this value investing is holding companies. Like some of the business houses, like say Bajaj, they have a company called Bajaj Holdings, where they have 50%, 15%, 20, mostly 30, 40, 50% in all the Bajaj group companies like Bajaj Finance, Bajaj Auto, all companies. And when you combine the value of their holding in all these individual separate companies, and then say the figure that we get is a 1 lakh crore, then these holding companies, they are available at 80% discount. So the market cap of that holding company will be not more than 20,000 crores. So you feel that since the worth, it's the companies that they are holding are worth 1 lakh crore. If you buy them at 20,000 crores, you already have a 5 acre at your hand. But remember that these companies are just holding companies. They don't have any operating business. And the only purpose why these groups have formed these holding companies is to protect their controlling rights in those countries. So basically, you will never be rewarded by investing in these holding companies. When the market is bereft of any investment ideas, when the market has reached really very high valuations, and when people start finding value in the stock markets, then that is the time when these holding companies will come to the fore. People start investing, they may even in the short term double or so, but it is very very difficult to make money by investing in this. Most of these value investing companies have good dividend yield, but as I will show you in subsequent slide, it is very if the company's dividend yield is very high, then you have to beware, because the company is not showing any growth. So that we will see in the. So what has been my approach? Only growth stocks at reasonably high PE. So what is growth investing? Basically, it is like you are investing in a product which is in high demand, like say for pizza, where we feel that the young population and this modern small family norms, and both the husband and wife doing jobs, and this young population college going kids, pizza is a very popular food nowadays for the youth. Then these cars like Maruti cars, washing machines, two-wheelers, paints, beverages like beer and alcoholic beverages. We feel that there is going to be huge demand for them, and the per capita consumption of all these as compared to waste is way below in India, and so there is huge likelihood to be huge demand for these products. Then you assess the target market also, like so two-wheelers. When people come from the bottom of the pyramid, their income levels rise, they are going to buy two-wheelers. Person who is riding a bicycle will buy a two-wheeler. So this is how. And then you try to analyze the competition also. Like if there is so for example Nestle or Pidilite. So Fevicol has become a brand. If any carpenter in India wants to use adhesive, he will say Fevicol only. It has become synonymous with the brand. The brand has become as a product like Xerox used to be. Nestle, Nescafe, Maggi, ITC tried very hard, and they did come up with an alternative to Maggi. But anybody who goes to a superstore will say, show me Maggi, give me Maggi. So that is how it works. Then there is opportunity size, like say for example Titan, where we know that nowadays everybody is realizing that if we buy from some other small jeweler, then you are likely to be cheated. And the Titan, the Tata brand has the trust, the brand. So people prefer to buy jewelry from Titan. Even the old timers who used to hate Titan and used to go to the family jewelers, they have started going to the Titan Tanishq brand, for opting for the Tanishq brand. Then when you try to use this growth investing approach, you try to find out whether the company has moat or not. So the moat can be in the form of brand like Maggi, Fevicol, Jockey. It could be the moat of branch or reach. Like some banks have so many branches, that is the moat of PSU banks. They have so many branches, and the newcomer like IDFC Bank or Yes Bank, they have very few branches, so they cannot compete with the PSU banks if the management of PSU banks were efficient. So that is the moat of branch. It is nowadays being obliterated by e-commerce. There was a very interesting article by Akash Prakash in Business Standard that this brand, they are losing their what you call value because of the advent of e-commerce. Because on the e-commerce platforms, even a new brand gets the platform to sell his product. He did not spend so much on advertising and marketing. to establish his brand because he has got this wonderful platform of e-commerce. And there is more of technology. So private banks, they are far ahead of PSU banks. And there could be more of capital. Some, like for example, the recent example is Bajaj Finance, other NBFCs. Bajaj Finance is not capital strive. Most of the NBFCs are struggling to meet their obligatory needs. They are finding it difficult to raise money. Similarly, PSU banks, they have capital adequacy ratio in single digit, 4, 5, 6%. We keep hearing that government is trying to infuse 50,000 crore or 1 lakh crore in PSU banks. Private banks have never needed to raise money. So that is the mode of capital. Then there are some businesses which are capital intensive. So in a way, capital intensive businesses should be avoided. But if you want to start, say, a new cement plant or steel plant, you need so much money, and that itself is a barrier for new entrants. So that is a mode of capital. Then there could be a mode of agreement with customers, like specialty chemicals or some pharmaceutical companies who do the outsourcing work for MNC pharma companies. So there is a stringent process and through which they have to pass of quality controls before they can get into agreement with these MNCs. And these agreements are for a period of minimum 2 to 3 years. And for any new entrant to impregnate this business, it becomes very difficult. And then there is mode of management and people like for example Aditya Puri of HDFC Bank and Deepak Parekh of HDFC. The moment these people are nearing retirement, there will be a buzz in the stock markets that who is going to be a successful or capable follow-up leadership. Then once this is then how do you select companies? So basically magazines, newspapers, TV, web, local marketplace. Like for example, this is one very good example which I have used. TVS Motor versus Hero MotoCorp. So I am into motor biking. We go for biking on weekends also. So when you go on the highways, you see that there are none of the hero bikes. TVS has basically, even in today's Divya Bhaskar, there is on the front page there is an article where even in the poorest of the and the most backward Indian villages of UP and Bihar, people have started opting for high-end motorcycles. That is, motorcycles worth more than 150 lakhs or more than 150cc in capacities. These are the people who spend a lot of money in R&D to develop their own house in Apache brand, which has become highly successful. And Hero has been a bit complacent ever since Honda exited. What they have been complacent. They haven't spent any money in R&D. They are still coming out the same 100cc motorcycles. So because they were having more than 50% market share. So this is an example. When you go, and then another trend which was emerging was scooters versus motorcycles. So scooters was a new trend, and there was no competition for TVS other than Honda. Hero were not into scooters. Bajaj have exited scooters, and his MD has admitted publicly that that was a huge mistake. So this is how you can. Then these Eicher motors. We all know that my friend, when he bought his bullet motorcycle, he had to wait for 6 months. Then we decided we had planned for a bike ride to Leh Ladakh. Another friend went to buy this Royal Enfield, and he got it immediately. So we know from the local marketplace that the demand for Royal Enfield or a bullet motorcycle has gone down drastically. So this is an example. Eicher Motors, my friend, he bought Jigish bike. He bought it at 32,000, and I had at that time told him that you are a little bit late. This is 2 years ago. Stock was quoting at 32,000. I had told him at the time. Same is the example with Maruti. In Maruti, Baleno, Brezza, they had waiting period of 6 months. Now you see daily, you see advertisements in newspapers. They are offering huge discounts. There is inventory, huge inventory. So this is another example of local marketplace. Then you go and visit the superstores, Maggi, Nescafe. So this is how you can pick Nestle, which is one of the greatest compounder of cafe on investing. Then this is something that I have tried, but I have not been successful. That is glancing to the west. This is the example that Ramesh Damani used to give us. He used to give us the example of United Spirits. At that time, the McDowell, the stock was available at 40 rupees and at a market cap of 200 crores. That is, if you buy all the 100% stocks of McDowell, all you need is 200 crore rupees. The company had 50% market share in liquor market, and India being the and the per capita consumption of liquor was so minimal. He said, "You go and buy this, you won't regret." McDowell from 50 went to 5,000 rupees. That is 100 bagger in a period of 4 to 5 years. It's unbelievable. So that is, he used to tell us, because this is the valuation that the companies in the liquor companies in the West, like Diageo, they are getting in the West. So there is a disparity and there is a price discovery that has not happened as yet. But another example is pediatrics. Like when we were in UG, pediatrics was the hottest, the most sought after branch. You had to be in the top 5 to get into pediatrics. But some of our friends who had gone to the US, when you ask them, they would say that you can go to get admission only in pediatrics, because that is the worst branch in the West, because you don't get any infectious disease. Your practice is essentially well baby clinics. You immunize the children, diet advice, how to do proper parenting, growth monitoring, development monitoring, and so on and so forth. And we wondered that how is it possible, and we have already almost reached that stage in India, as far as practice of pediatrics is concerned. The evidence of this is that in the only recently someone had posted on WhatsApp that in the state of Maharashtra, of the total top 100 rankers in NEET, only 2 had opted for pediatrics. Out of 100, only 2. And there also I am certain that they must have parents who must have been acting against pediatricians. So so that is another example is, this is what I have invested in PV18 since 2013. It hasn't worked out. The hypothesis over here is, I will just take 1 minute. It is very I would invite comments from the audience also, whether I am right in my hypothesis or not. The way we have been watching television has changed enormously over last 5 years. Like for example, when we had, if we had one connection in our hospital and there were 15 TV sets, we had to pay for only one connection. And we would get, everybody would get to see television channels on all the TVs, 15, 20, 25, whatever. Then they started this set-top box digitization. And they initially started with only tier 1 cities or the metros, then it gradually percolated down, and now it is there in even the smallest of the small villages. So now what is happening is that I have to shell out 15 times more amount for watching channels on 15 television sets. That is one change. Another change is the recent change, and that is till this financial calendar year 2018, we had no choice in what we wanted to see on television. There were certain packs which every operator would come out with. You had to subscribe to those packs, and even if you don't want to see certain channels, you were given. So the channels were thrust on you. Now, so it was basically a B2B business when it comes to broadcasters. Like for example, TV18, they have channels. They have so many channels, right? CNBC, TV18. Now you would be surprised to know that 1 month rent for watching CNBC TV18 is only 4 rupees. So my hypothesis is only this, that agreed that many people who are not interested in financial markets, they will not subscribe to this channel. But all those who are present, or all those who have an interest in financial markets, don't you think that they will be willing to pay at least 1 rupee per day? At least 1 rupee per day. Remember, when we are doing our medical studies, we used to go to LP theatre, 5 rupees balcony. Now we have started paying 200 rupees, 300 rupees for watching those same movies. So the hypothesis here is that if these 4 rupees becomes 30 rupees, they have fixed costs as far as the programming costs are concerned, the staff cost, etc. They don't, it's not a capital intensive business. So whatever the cost is, the cost of salaries and manufacturing, program manufacturing cost. So when you look at the waste, the companies in the media like Viacom 18, they don't have such a large audience. We have over here in India 130 crore people, out of which at least 100 crore people, if not more, will have access to television. And in India, people are not very rich, so they are on the lookout for very cheap entertainment. It cannot get cheaper than this. So the day they start raising the prices, they have channels, say in news channels, business news channels, entertainment channels, Hindi entertainment, English entertainment channels, MTV channels for the youth. The day they start raising this, and it will happen, certainly. The stock could, it may not, I have waited for 6 years, hasn't given me much returns. It could shoot through the roof. It may not happen, it may happen. So this is how you try to select companies when investing in stock markets. Then there are certain screeners, online stock screeners. Some of them are paid, some of them are free. Amongst the paid one is Capital Line. They charge almost 2 lakh rupees per annum, if I am not wrong. And amongst the free one is the most common is Money Control, equitymaster.com and screener.in. So these are very useful tools where you can, you can select certain criteria like show me companies having at least minimum 15% sales growth, companies having minimum 10% net profit margins, debt-free companies, companies having more than 50% promoter stakes, and so on and so forth. And the software will come up with a list of companies. Now, once you have come across a stock which you feel is investment worthy, then you have to analyze the stocks on various parameters. One of them is valuation analysis, second is financial analysis, third is management analysis. And I would say that in the current environment, we should give highest weightage to the most ethical management. The markets are rewarding them like anything. They don't mind paying a PE of 50, 60, 70 to companies where management is very transparent and you are certain that there are not going to be any shocks. And those companies where management has been found to be dishonest, the stock prices have been hammered like anything. So that what are the various valuation matrices? So one is PE ratio. Everybody knows it, so I am not going into detail. It is a subjective parameter. As I said, someone may say that 15 P is okay with me. Someone may say that 45 P is okay with me. Second is nobody, when we talk about the PE, nobody focuses on the earnings, that is the denominator. Everybody focuses on the numerator only, the price. So what essentially I mean to imply is that you need to focus on the denominator and the earnings and figure out whether the earnings are abnormally suppressed temporarily and are likely to rebound or are likely to continue rising at a very brisk pace. That is something that you need to figure out. So don't put too much focus on the price earning multiple, because the prices, they change daily and it is basically a function of demand and supply, as already discussed. Nobody focuses on the earnings, and the earnings don't change daily, they change quarterly and then yearly. Don't focus even on the quarterly earnings, right? Because markets, you discount the future. This is like low P is basically essentially a junkyard of the stock markets. All the stocks which are not investment worthy, they are in that yard. So don't venture into this. This is one example, very hilarious. Like in the IT boom, I had missed out on the IT boom. All the stocks, Infosys, etc., were trading at 50p. So one fine day, I purchased a copy of Capital Market, where there are companies are separated in a tabular manner. Like all the companies of software are in one group. So I just ran down the PE ratios of all, and these are the two companies that I came across: Virinci and Vises. Nobody heard about. Nobody had discussed about. They were available at a PE of 5. Infosys PE of 50. These two PE of 5. I thought the markets are foolish. Why have they ignored it? And I have really discovered a gold mine. So I bought both these stocks, Virinci and Vises, at 40 rupees without paying any attention to anything else. After 2 years, sold them at 20 rupees. The story does not end here. This is a story of 2016. 3 months ago, I got a notice from IT department saying that you have traded in these stocks to gain capital gains and evade taxes. Fortunately, I had all the bills and the matter was resolved. But this is the pitfall of investing in low PE stocks. Then when you are focusing on PE, remember you should focus on the margins. So this is an example. If, for example, if it is a commodity, usually commodities, they are cyclical businesses. When the cycle is up, the profits are high, the earnings is high, so PE will be less because EPS, the denominator, is very large. So PE will be less. Never buy commodity stocks when the PE is low. Buy them when the PE is very high. Because when the PE is very high, it means that the earnings, the EPS has shrunk drastically. 5 minutes. Okay. Okay, so don't buy commodity stocks. Another example is Lupin, where Lupin was voting at 2200, 35% growth, and the margins were at the historic high of 35%. When you see the historic margins of the company, you know that these margins are not sustainable. The margins are bound to come down. Once the margins come down, earnings will fall, and the stock price is correct. Now, what is the shortcoming of focusing on PE? So basically, there is no information on growth, debt, management quality, whether the business has any pricing power, and so on and so forth. And then this is the most talked about point in our WhatsApp group, with due respect to Nitin sir. Like, don't invest in stock markets when the market PE is at, Nifty PE is at 26, 27, 28. So that is the biggest, in my eyes, that is the biggest felony or myth. Because if you focus on the Nifty companies, there are 50 companies or 30 companies in Sensex. More than 70% companies, they have zero earnings. Only a handful of companies are showing EPS growth. So when we collectively do the market P, how do we come at the market P? We add market capitalization of all the companies in the Nifty and subtract it by the earnings of all the companies, right? So many companies have zero earnings, so naturally the denominator is very low, artificially low, and that is why you feel that market P is very high. But actually there are so many companies or stocks in the market where the earnings are good and the PE is low, right? So this is of course a personal thing. So I don't focus on the market PE when I want to invest in a stock which has good fundamentals. So this is the PE. Let me finish this. Low PE trap. This is an example. I had invested in Aurobindo Pharma at 110 rupees in September 2013, and I thought that the stock is very good. So I kept on increasing my allocation till it reached 10%. This was the time when I had entered into pharma using the top-down approach. I had 5 stocks in pharma. So once I had reached 10%, I thought, let me buy another stock. So I bought Arvind Remedies. Now nobody had heard about this stock. Price was 45, PE was 4. Here the PE is 30. But look at I had focused only on PE. The growth was minimum, here the growth was 30%. It has a high debt, even this has also high debt. The business basically it is bulk drug. And this is branded generics and exports. This is negative cash flow, this is very high cash flow. The cost of debt here was 20% because they had loans from Indian banks. These were FCCB loans where the interest rates were 0-1%. So the cost of debt was 1 to 2%. This is the CMP of Arvind Remedies. The stocks are still lying in comatose state in my demat account. This is the CMP of 800. That was few days ago. This is the example of top down. Market cap to sales ratio. This is another parameter. Arvind Remedies at market, we haven't as yet gone to those slides. Had a market cap to sales ratio of 0.25, meaning a very attractive valuations. This was also attractive, but market cap to sales was 0.9 only. But when you compare the enterprise value to sales, that is when you add the debt, then this was more than 1. What is the myth busted here? Pharma is a defensive sector. What are the lessons from this? Diversification is diversification. If I had not gone for, I had purchased Arvind Remedy only because my allocation to Oro had exceeded 10%. I would not have purchased Arvind Remedies. Then there is the PE trap. Always focus on debt and interest burden. Always focus on growth. Never invest in low growth stocks. And this is the most important. Whenever you analyze a company, basically if the company has free cash flow, then and then only you should invest. And then the quality of business also that you have to, like that was in branded generics and this was dull. Arvind Remedies was bulk drug. So this is another example where it has given me a lot of satisfaction. So because of lack of time, I haven't skipped the previous slide. Another ratio is when valuing the companies is market cap to sales. Remember, what I find is that small is always beautiful. In the sense that when you are young in your practice, you are, for example, you have an OPD of 10 patients. It is very highly likely that it is going to go to 20, 30, 40. When you are already seeing 100